welcome back. If you're looking to master the heavy-duty financial mechanics that keep massive organizations running, you are in exactly the right place. Today, we're taking a really fascinating journey through the complete chronological life cycle of property, plant, and equipment, or PP&E. We're going to track a capital asset from the very first spark of an idea in the planning phase all the way to its eventual disposal. Think about this for a second. How exactly does a massive global corporation drop tens of millions of dollars on, say, a new factory without losing track of a single dollar? The financial stakes here are absolutely astronomical, and the compliance controls involved are incredibly strict. It takes a highly structured life cycle to keep it all together.
Okay, let's dive straight into this. Here's our roadmap. We're looking at 1. Planning and authorization. 2. Acquisition and initial measurement. 3. Leases and leasehold improvements. 4. Calculating asset depreciation. 5. Impairment and subsequent costs. And finally, 6. Verification and final disposal.
All right, Section 1, Planning and Authorization, the birth of an asset. Listen, before a single dime actually goes out the door, there's a huge hurdle to clear: strict board approval. We're talking a rigorous, SOX-compliant procurement process. First off, for any significant capital expenditures, your CapEx, you're going to need a minimum of 3 competitive bids. Then, that purchase order, it has to specifically reference a capital expenditure authorization, or CEA number. And to top it off, you need CFO-level approval, at least. This rigid chain of custody is exactly what stops unauthorized spending in its tracks.
Moving on to Section 2, Acquisition and Initial Measurement, establishing the baseline.
So, the asset is officially born. Now, depending on how it's acquired, maybe it's purchased outright, self-constructed, or even donated, we have to establish its baseline under accounting standard ASC 360. And right away, companies face a massive decision. Do we capitalize or do we expense? To capitalize, the asset has to hit 3 strict criteria. It needs probable future economic benefits, a reliably measurable cost, and it must sit above the company's capitalization threshold. If it's just routine maintenance, or it falls below that threshold, boom, it's expensed immediately. And a quick warning here: inconsistently applying that board-approved threshold is a massive SOX compliance risk. You've got to be consistent. Now, when this asset is born, it needs a birth certificate, right? In the accounting world, we call this the Fixed Asset Register, or the FAR. This central database is everything. It doesn't just hold an ID number and a location, it dictates the asset's entire financial destiny. From day one, it captures both the GAAP book depreciation schedule for financial reporting and the MACR's tax depreciation schedule for the IRS. Section 3, Leases and Leasehold Improvements, the rent versus own nuance. Sometimes you don't actually buy the asset, you just lease it. And under ASC 842, the whole rent versus own dynamic gets really interesting. If you're leasing, you have to run it through 5 specific criteria to see if it qualifies as a finance lease. 1. Does ownership transfer at the end? 2. Is a purchase option reasonably certain? 3. Is the lease term 75% or more of the asset's economic life? 4. Is the present value of the payments 90% or more of its fair value? Or 5. Is it a specialized asset with literally no alternative use? If you hit on just one of those criteria, you are forced to recognize a right-of-use asset and a lease liability right there on your balance sheet. Okay, I need you to pay close attention to this next part because it's a huge trap. If you're making permanent improvements to a lease space, like building out custom offices in a rented building, you absolutely cannot just depreciate those improvements over their physical useful life. You have to depreciate them over the shorter of their useful life or the remaining lease term. Honestly, messing this up is the single most common error in PP&E accounting. It leads to massive painful write-offs if a lease suddenly ends. Let's look at Section 4. Calculating asset depreciation, aging book, and tax. All right, so we're entering the aging phase, where we systematically reduce the asset's value over time, for both financial reporting and tax purposes. But when does the clock actually start? It all hinges on the placed in service date. This is the exact moment an asset is available and ready for its intended use. So if you're building something from scratch, what we call construction in progress, it's the exact moment you sign that commissioning certificate. That signature flips the switch, moves it into PP&E, and officially activates the depreciation schedule. Now, what's really interesting about this is how completely business math diverges from tax math. For the books, under ASC 360, a company might just use a simple straight-line formula, right? Cost minus salvage value divided by useful life. Easy. But for the IRS, you're forced into MACR's tax depreciation, which uses these incredibly rigid, prescribed recovery periods ranging anywhere from 3 to 39 years. It's like living in two completely parallel financial universes. And speaking of taxes, check out this wild fact for our current year of 2026. The IRS has been running this bonus depreciation phase-down schedule. A few years back, in 2023, you could instantly deduct 80% of an asset's cost. Fast forward to 2026, and that bonus rate has plummeted to exactly 20%. And next year, it hits 0. So yeah, timing your asset purchases literally pays off. All right, Section 5, Impairment and Subsequent Costs, when assets get sick. Look, sometimes things go wrong. An asset underperforms or the market tanks, and we enter what I call the illness phase under ASC 360. But we don't just guess if an asset is sick. We are explicitly looking for these 6 triggering events. We're talking about a significant market price decline, an adverse change in its use or physical condition, a negative shift in the legal or business environment, crazy cost excesses, ongoing operating cash flow losses, or if you expect to sell it off way early. And remember, we only test for impairment when one of these specific events is triggered. We are not testing this annually. So let's say a trigger does hit. You immediately enter a very rigid 2-step test. Step 1 is recoverability. Basically, can we get our money back? You compare the undiscounted future cash flows to the asset's current carrying amount. If those cash flows are lower, boom, the asset is impaired. Then you move right to step 2, measurement, where you calculate the exact financial hit by subtracting its true fair value from its carrying amount. And please, whatever you do, remember this rule. Under U.S. GAAP, once you recognize an impairment loss, there is absolutely no reversal. Some international standards might let an asset's value bounce back on the books if conditions improve, but not U.S. GAAP. Under U.S. rules, you write that sick asset down permanently. Once it's gone, it is gone for good. Finally, Section 6, verification and final disposal, death and postmortem. We've reached the end of the line. This is the post-mortem phase, where assets are physically verified or officially deregistered and disposed of. And listen, if you skip physical verification, you run the massive risk of being haunted by ghost PP&E. I know, it sounds a bit spooky, right? Ghost assets are basically assets that were thrown away, sold, or literally just vanished. But because nobody filed the paperwork, they are still actively depreciating on the fixed asset register. It's a very real nightmare that leads to wildly overstated financials and massive SOX compliance failures. To keep this financial disaster at bay, companies rely on a strict matrix of controls. Ghost PP&E? You stop that with regular physical verifications. Those tricky leasehold improvement errors we talked about earlier? You prevent those with proper lease term analysis. And unauthorized CAPEX is shut down by that rigid CEA approval process we looked at right at the start. Ultimately, proper SOX Section 404 controls are the shield guarding this entire lifecycle. Zooming out for a second, executives monitor the overall health of this lifecycle using CAPEX utilization. This is a percentage that compares the actual capital spent against the unused, board-approved budget. It's essentially a pulse check to ensure the company is actually investing in its future without recklessly blowing past the limits set by the board of directors. Along those same lines, they closely track the average PP&E age, comparing net book value to gross cost quarter over quarter. If this metric keeps skewing older and older, it's a huge red flag to executives that their asset base is aging out. And that means they'll soon need to open the checkbook, authorize new spending, and start this entire life cycle all over again. All right, so we've tracked a capital asset from its budgeted birth all the way to its strictly controlled disposal. The mechanics of PP&E are definitely complex, but they make so much logical sense when you view them as a living life cycle. So as you think about these strict controls and procedures, I want to leave you with one provocative thought. Are there ghost assets secretly haunting your company's fixed asset register right now? Thanks for joining me on this explainer, and I'll catch you in the next one.